Microsoft is down about 18% in 2026, but Azure is still growing 39%. AI CapEx just jumped 66% to $37.5 billion. So is the market punishing Microsoft unfairly? Or is it finally pricing in the risk that all the spending doesn't pay off? Let's break it down. Real risk, no copium. Here is the plan first. Microsoft profit engine and why it's one of the most durable in tech. Then Azure growth and $37.5 billion capex question. After that, commercial backlog, Copilot adoption, and what the forward pipeline looks like. And finally, my bear case, my bull case, and 2026 verdict. Let's get into it. Before we talk about AI, zoom out. Microsoft is built on recurring revenues. Office, Teams, LinkedIn, Dynamics. Massive switching costs deeply embedded in enterprise workflows. Microsoft Cloud alone just printed $51.5 billion in revenue, up 26% year over year. That's not an experiment, it's a cash machine that happens to be accelerated. Azure grew 39% year over year. While cloud growth is decelerating industry wide, Microsoft is actually reaccelerating two drivers: enterprise migration that takes years to complete, and AI workload running through Azure's OpenAI partnership. The question isn't whether Azure is growing, it clearly is. The question is whether this pace holds as the base gets bigger and competition intensifies. Here is where it gets uncomfortable. Microsoft spent $37.5 billion in capex, up 66%. Data centers, GPUs, AI infrastructure. The bulls say this is the cost of winning the AI platform war. Bears point out spending is growing 2.5 times faster than revenue. If AI monetization takes longer than expected, margins feel the pressure. Now the forward pipeline. Commercial remaining performance obligation seated around $625 billion. That is contracted revenue not yet recognized, essentially locked in future spend. Enterprise customers are not pulling back. They're signing long term Azure and cloud deals. It doesn't solve the capex debate, but it tells you the demand is real and durable. Copilot is Microsoft's most direct AI monetization play. 15 million paid seats, up 160%. The thesis is simple: over 400 million Office users, $30 per seat per month. Even a small conversion rate means billions in incremental recurring revenue. The risk: enterprise buyers are still evaluating the return on investment. The bull case is simple. Azure keeps compounding in the mid to high 30s, while Copilot converts part of the Microsoft huge Office user base into higher value AI seats. As infrastructure spending stabilizes, margins recover towards historical level. If that plays out, Microsoft sustains strong growth, and the stock will have roughly 20 to 30% upside. Bear case: AI monetization disappoints. Copilot growth plateaus. Azure faces pricing pressure from AWS and Google Cloud. And CapEx keeps climbing without any proportional revenue payoff. Margins compress. The market will raise Microsoft lower. Downside from here 10 to 15%. The bear case is that Microsoft is bad. It's that the market priced in AI perfection. At around $401, Microsoft is cheaper than it started this year, but still not cheap in absolute terms. Upside scenarios 20 to 30%, downside 10 to 15%. That's roughly a 2 to 1 risk reward skew. Decent but not widely asymmetric. The key variable: watch Azure growth and CapEx trajectory over the next 2 to 3 quarters. My verdict on Microsoft going into 2026: quality compounder, fairly valued with an AI optionality kicker. The core business is rock solid, Azure is still compounding, and Copilot gives you a journey upside optionality. But the CapEx risk is real. My view: Microsoft is solid accumulate at these levels. Not a screaming bargain, but a high quality name with favorable skew. This is part of my full 2026 Big Tech Playbook. I've already covered Amazon and Alphabet, with NVIDIA Meta and the rest of the AI stack coming next. If you want the full picture, subscribe and hit the notification so you don't miss the next deep dive. Drop a comment. Are you bullish or bearish on Microsoft at these levels? I'll see you in the next one.